Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Yesterday afternoon, the Reserve Bank Board left interest rates on hold at 4.35%, and we may not see a cut anytime soon, with inflation remaining a persistent challenge for the bank. I'm joined today to talk about it by Westpac's Chief Economist, Luci Ellis. As I've mentioned before, Luci has a unique insight into the way the Reserve Bank processes this information and makes decisions, having been the Assistant Governor at the Reserve Bank until late last year, effectively the Chief Economist. Luci, welcome back to Fear and Greed.
Thanks very much, Sean. Great to be here.
What do you make of yesterday's decision and statement with it, and commentary by Michelle Bullock at the press conference afterwards, broadly?
We weren't surprised by their decision to hold. We weren't surprised by the inflation numbers that came out the previous week. We were only a little bit surprised about the trimmed mean, whereas the market was more surprised. And indeed, our inflation outlook for trimmed mean is almost identical to what the Reserve Bank published in its statement on monetary policy yesterday. What is a little puzzling is their view about how long they think they need to keep interest rates steady from here. They are still worried about upside risk to inflation. They have a very particular view about goods inflation. And while we always expected the RBA to be among the last to cut, if not the last, because they didn't go up as far, they don't have as far to go, the RBA does seem to now be constructing a view of their reaction function, which says that you don't start reducing the restrictiveness of policy until you're very, very close to target. Now, we know policy operates with a lag. We know that you actually have to start reducing the restrictiveness of policy before getting back to target. And that consideration didn't really feature in any of their communication yesterday.
Michelle Bullock, the governor, came out and said there were two options on the table. One was to lift rates. The other one was to hold rates, knowing that they would be on hold for a while. Is that, in your experience, and you've worked inside the bank, obviously, surprising that they didn't at least consider when a cut might be necessary?
The board are really conscious that things are uncertain, and they always have been. So they don't generally prejudge where they're going to be in 3 or 6 months' time. And in the periods where they have wanted to give more forward guidance, that hasn't worked out so well. And so, the governor has been very reluctant to provide any kind of forward guidance recently. We expected that the choice would be between a rate hike and keeping rates on hold. But, our view was that, with inflation coming down on the track that the RBA has been forecasting for quite some time, their trimmed mean inflation forecasts are almost the same as where they were in November. So your view of the policy shouldn't be that different. What seems to have changed, though, is that since May, they've changed their view about the level of demand and the level of supply. They've revised their view about aggregate demand up.
Yeah.
And they've revised their view about supply capacity and, in particular, productivity down. We're still assessing why they've come to that conclusion. It's not one that we necessarily share, but that does seem to be entering into their thinking. But it is very common for a Reserve Bank board to consider two different cases, even if they're not seriously considering one of them. In this instance, given how recently the inflation numbers have turned around, of course, they were considering whether to hike rates, but it just isn't something that we think will actually transpire, because they're also conscious that the level of rates where they are is causing a lot of pain in the community. So as long as inflation remains on track, they'll have to remain vigilant. They'll have to, keep the rhetoric very robust. But ultimately, they're going to be in a position down the track that they can say, okay, we're close enough to target that we can start removing the restrictiveness of policy. They won't be in a hurry to do that, and they're clearly in less of a hurry than we would have expected. But, that's the profile that they're looking at.
Stay with me, Luci. We'll be back in a minute. I'm speaking to Luci Ellis, Group Chief Economist at Westpac. Just help me understand the aggregate demand comment you just made then. The Reserve Bank in their statement yesterday certainly sounded more optimistic about aggregate demand, if that's a way of putting it, than I thought, particularly given the cost of living crisis, the pressure people are under. Aggregate demand is all of demand, as the name suggests. Is that because there's too much government spending? Is that because actually households aren't as poorly off as we thought? Like, just unpack that aggregate demand comment for me.
Well, it does take quite some unpacking. As best as we can tell, there are two main changes driving their assessment. One is that there is more government spending than they had in their forecast previously. The other is that they have pushed out their population growth profile. So Westpac Economics is one of the few outfits that actually puts out a projection for population growth over the near term independently of government. We've been expecting that population growth would be around that 1.9 to 2.0 rate for 2024 for a while. In its May forecast, the RBA had a slower rate of population growth this year. They expected that rollover after the surge in population when the borders opened to happen faster than it's actually happening. So they've moved their population growth forecast to be more in line with what we already had. And so that's increased their view of, overall growth in the near term, the overall level. Now, if you're adding more people, you're adding more demand, but you're also adding more supply. So the other piece of the puzzle, in addition to the public demand that they're seeing, is also that they have downgraded their forecast for productivity growth. This is a long-standing uncertainty after the pandemic. Our own view at Westpac Economics is that productivity growth is rolling over because the slump in productivity was, in our view, a ripple effect from COVID, and it just will take some time to wash out. But the Reserve Bank's taken a more bearish, a more pessimistic view of how quickly that can turn around than we have.
So what's your best estimate about when the Reserve Bank will move on interest rates?
Well, up until yesterday afternoon, we were expecting rates to be, the Reserve Bank Board would be in a position to start cutting rates in November. Our forecast for inflation hasn't changed, and theirs is in line with ours. So, if they had the reaction function we thought they had, they would be cutting rates in November. But given the language in the statement on monetary policy, given what the governor said in the media conference, even if things play out as we expect, we just don't see they will see their way through to pivot that quickly. So our forecasts are under review at the moment while we assess the basis for the Reserve Bank's economic outlook.
Luci, I've got to ask you the question about what it's like inside the Reserve Bank, because you have been chief economist, you've been involved in all these discussions. Albeit not this year because you're obviously at Westpac, chief economist at Westpac. But is there a lot of toing and froing going? Do you turn up with your forecast? The economics team turn up with their forecasts, and there's a lot of debate about it. I'm just kind of interested in the process in those meetings.
Well, without giving anything away that's not already in the public domain, there's a couple of speeches that go through the process. Glenn Stevens gave one some years ago. Michelle Bullock, I think it was, gave one as Deputy Governor where she talked through the process and the timing. Now, some of those things have changed since I left because of the recommendations of the Reserve Bank review. The board now meets over 2 days. So instead of squishing all the discussion into 3 hours on a Tuesday morning, they have both the Monday afternoon and the Tuesday morning. They have a lot more intermeeting interaction with the board than used to be the case. And so there is an opportunity to kind of test and, shape the view about what the outlook looks like. But what essentially I think is going on here is it's not so much about how they've tested the forecasts. As I said, their forecasts of trim mean are almost identical to ours now that they've revised their forecasts in the most recent statement on monetary policy. What has changed is they've become less forward-looking. And so what has changed with the Reserve Bank review recommendations is they are now much more focused on this idea of the level of aggregate demand versus the level of aggregate supply. And that's sort of a framework that they didn't rely on as heavily in the past.
Fascinating. Luci, thank you very much for talking to Fear and Greed.
Thanks very much, Sean. It's great as always.
That was Luci Ellis, Group Chief Economist at Westpac. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.